Hello traders, welcome back to UZFX. Welcome to another episode of Learn Smart Money Concepts, episode 2. So in this episode, we're going to be talking about some basic terms that you're going to be hearing in smart money concepts. So these are the terms that we will actually be using to trade the smart money concept. I would have actually went ahead to do a video on how to trade the smart money concepts. I just decided to take it piece by piece, so that everything can assimilate. So I just, thought of first of all creating a video on how to, on the basic terms in SMC before creating a video on how to trade it. So I'll be creating a video on how to trade the SMC in the next episode. That's episode 3. So first of all, you're going to be looking at the terms in SMC. We're going to start with the order blocks. I know you must have heard it on the other video which I did. So we're gonna talk fully on what an order block is. Okay. So order blocks. That's OB. We call it OB. So what are order blocks? Order blocks are basically basically areas in the market that is characterized by an impulsive move, either on a sell side or on a buy side. Let us hop into the charts. Let me show you that. Right here we have NZD USD. As you can see, in this NZD USD, you can see this candle right here. This green candle right here. Let me mark it out. You can see the green candle right there. That's what we call an order block. This is actually a bearish order block. Why is it a bearish order block? Because after the order block, the market went down. So how do you identify an order block? Another block is basically the candlestick that is formed before an impulsive move, either down or up. Right here we have a bearish order block. So this green candle is actually the order block. So you mark it from right from the point, the low to the high of the candle. So all this area is what we call an order block, and this is a daily order block. So and order blocks on higher time frame tend to work a lot more than other blocks on lower time frames. The higher time frame controls the lower time frame. The higher time frames control the lower time frames. So in this video, I'll be talking on the terms, from one after the other. So in other blocks, after the institution must have created another block, they come back to that other block. They first of all create liquidity before coming back to mitigate the other block. So you can see the liquidity here. We have equal highs. Liquidity are basically equal highs and equal lows. So here we have equal highs right here. We have equal highs. So this is basically liquidity. So they kind of come back, because basically people will be trading, will be shorting this market right here, but they will go back, grab this liquidity, close these orders. Because why is it another block? It's another block because they basically they have a buy position and also a sell position. They open a buy position in the sense to trap traders that are going long from this resistance zone. So they opened a buy trade that is lesser than the sell trade. So they opened the sell position, which is the intended direction, after trapping traders. So right here, traders actually that doesn't know more about much about liquidity in the markets, they actually went long here, something like that. Then they had to take out the lows. They took out the lows with a strong impulsive bearish candle, thereby creating what we call an order block. They have to come back to this order block to actually close that buy position, because the buy position is actually in a drawdown. So they had to come back and close the buy position and then continue moving down or moving up in any direction that they intend to move. So that's what we call another block and how it is identified. You have to, go. It is identified by a strong impulsive move and a strong impulsive move and a break of structure. So you have to see a strong impulsive move and a break of structure, as you can see here. So this one as well, you can't say this is another block, no, because we don't have any break of structure. Here we have another block and we have a break of structure. Just like here as well, we have a bullish order block. As you can see, we have a bullish order block, and a bullish order block is just simply the opposite of what a bearish order block is. So a bullish order block is just basically the last down candle before an impulsive move upwards. So we can mark out this candle. It mustn't be a red candle or a green candle. It's just basically the last candle before an impulsive move. As you can see this big candle. That's a large impulsive move. So after this impulsive move, you could see how price went up straight. After that, they came back as well and closed some sell positions which they had here, because they sold this market down. As people were selling, they thought the market would continue to sell. So people were thinking that the market will continue to sell. So they were adding sell positions, while the smart money is adding buy position. They first of all induced the retail traders, or basically any trader, into going short by opening small sell position and opening another buy position at the same time. So they had to come back as well to close this sell position that is on a drawdown here. So as you can see, they came back as well, closed the sell position, added more buys, as you can see. So that's what we have on order block. So let's go to the next term. So what's the next term in smart money concepts? Okay. Okay, we have the fair value gaps. You have the fair value gaps. That's fair value gap, or we call it inefficiency. We call it or inefficiency. Or inefficiency. We either call it fair value gap, FVG, or inefficiency. So what are fair value gap and inefficiency? Let's go into the chart. Let me show you. Fair value gap are basically areas in the market that has large or impulsive moves, creating what we call, like, it creates an area which the market needs to come back and fill. Just like here we have an inefficiency here. Let me find a correct one. Look at what we call an inefficiency in the market. From here, this point to this point, it's actually what we call an inefficiency. So price will have to go back most of the times to fill these inefficiencies. So you can see it from this point. So this is what we call an inefficiency. This space right here. So let's go over to the next term. You hear stuff like buy side liquidity. Buy side liquidity, that's BSL. You hear stuff like buy side liquidity, BSL. So what is BSL? It's basically a way the smart money trap traders that are going long. Let me show you that in a chart. Okay, maybe let's use another pair for this one. Let's use GBP JPY. Let's go to the daily time frame. Yeah, here on the daily time frame. Yeah, exactly. This is what we call the buy side liquidity. So you could name it like this: buy side liquidity, BSL, buy side liquidity. So basically, some traders that trade breakout and resistance would be trapped inside this area. They will be trapped inside this area. They'll be going long inside this area. So basically, they are trapped in this move because this is a fake out. It can be a kind of a fake out. So this is what we call buy side liquidity. They are taken out. This is actually in a place in the market where the buyers are actually taken out. So we have another one, the sell side liquidity. That's the SSL. And the sell side liquidity is just the opposite of the buy side liquidity. Let's find another example on this one. Yeah, exactly. You can see right in this zone, most traders will be going short after the breakout of this support line. Most traders will be going short from here, but what happened? They got taken out. So they grabbed the sell side liquidity of the market. So you could actually call it sell side liquidity. So they grab the sell side liquidity of the market. So mark it out. We call it sell side liquidity. As you can see, they did the same stuff as well here. They grabbed the buy side liquidity a little bit, kind of a little fake out in this area. So that's what we call buy side liquidity and sell side liquidity. Then we have stuff like change of character. Change of character. That's change of character. That's shock. Change of character. You'll be seeing stuff like this while I'll be trading the smart money concept. You will see stuff like the change of character. So what is change of character? It's basically a shift, or that's a shift, or when the market is about to turn either bullish or bearish. Just like here. Let's go to the 4-hour time frame. Right here in the 4-hour time frame, before the market reversed from this point, let's go to 1 hour. Before the market reversed from this point, you had the market broke this area. So right here, this is what we call change in character. So you will label it as well. We call it change in character. It basically is a point where the market decides to either go down or go up. And we have another term, you could as well call it break of structure, as the case may be. You could call it BOS, that's break of structure, or BMS, break in market structure. And then whichever one you like, you could call it. So we have another term. You have the breaker block. From the knowledge of an order block, we get what a breaker block is. From this spot, from what I already said about order blocks, the last down candles or the last up candles before an impulsive move. In this area, we see how this impulsive move happened. So this is an order block. So this area is another block. You'll be wondering why didn't this area react when the market came into it? Why didn't this order block work? I will be talking on all these stuffs in the next video, how to find other blocks that will be that has high probability setups that will eventually work while you are trading. You can see how this one, it was actually violated, it didn't work. So in any case an order block gets violated, that's what we call a breaker block. We call it a breaker block. As BB, breaker block. So in this point, we call this a breaker block because this other block failed to hold. And once another block fails to hold, it turns into what? A supply. Because this is a bullish order block, it's serving as a demand zone, but it failed. Hence, it will turn into a supply zone. You can see how the market went down from this point. So anytime you see a breaker block, just simply wait for the next, check for the next bullish candle that formed, so that you could take your sales from there, because eventually the market will continue going down from that point. So this is what we call a breaker block. Then we'll be hearing stuff like high of the day, high of the week. These are basically the points in the market where the market stopped for the day, the highest point in price for each day. That's what we call the high of the day. So let's check from this point. This is actually 16 June 2022. So from this point, and this is actually 1600 hour. So where is the highest point for this day? You could see it ended on here 2024. So this is the highest point for this whole move. Let me mark it out. So we have the beginning of the day from this point. We have the beginning of the day from this point. To this point. So where is the highest point in this? This is in 15 minutes time frame. So where is the highest point in this whole price action? You see we have the highest point here. Here is the highest point. So this is what we call the high of the day. As well, this is the lowest point. This is what we call the low of the day. That's the LOD and the HOD. Then we'll be hearing stuff like premium price, equilibrium price, and discount prices. Then let's use another chart for this. Let's use maybe the Euro USD. Okay, what are premium price, equilibrium price, and discount prices? Just like when you are about to buy a goods or purchase, get a particular good, you have to. Everybody wants to buy on a discount, so nobody wants to buy at a premium price because it's basically costlier. So we're going to be relating this with the market, how the market works with discount prices and premium prices. So let's find a nice order block. Okay, let's go to the daily time frame. Okay, here on the daily time frame, you could see another order block formed right here. So that's another block. Let's adjust that a little bit. So you can see a nice order block. So what are discount prices, premium prices, and equilibrium prices? Let's take our fib. You drag it from this point to this point. So from this point, your equilibrium prices are basically the 0.5 of the fib, considering a certain range. We are considering this range from this point in regard to this order block. Let's say you are trying to sell from this order block. You have to wait when the price is at premium. Premium is anything below the 0.5. So here is our premium price. So here is our equilibrium price, 0.5, and from 0.5 upwards is what we call our discount. So the smart money traders are basically looking for the discount levels to trade from. As you can see, the price went high above the 0.618 of the Fibonacci. So these are areas that we call the discount zones. These are the discount zones. The discount zones. The 0.618 and the 0.786 are the discount zone. These are areas that will be looking for entries whenever you are trading the order blocks. So they're basically the places that you'll be looking for entries. Anything below the discount price is just basically liquidity. As you can see how price, you're just scratching this zone before it eventually went straight into the discount level or discount price, and hence price tanked down, came back again, went down. So this is what we call the discount prices. We call it discount. So we call it discount level. Here is our discount level. Here. So these are places you will be looking for entries. So we'll be copying all these stuffs in our next video. We should be talking on how to trade the smart money concept. So then you'll be seeing stuff like you'll be hearing stuff like accumulation, distribution, and the main trend. Let's get on that one. Let's clean up these stuffs. So what is accumulation? These are basically areas where the smart money try to make the market look as if it's going to keep on selling. As you can see here, you have a nice accumulation at this zone. This is what we call accumulation. The smart money accumulated price here. Accumulated price, the market has been very all along. It came to this zone, tried to make it look as if it's going to buy, as if it's going to sell, rather. As if it's going to sell, they went up, mitigated their order block, continue selling. So the accumulated price here went up, now came down. So what about distribution? These are areas in the market where the smart money try to make the market look as if it's going to keep buying, just like this area. You have a nice distribution in this area. You go down to the 4-hour time frame. You will see how price went up, came down again, went up again, came down, trying to present this market condition, or price, trying to present price as if it's going to continue the upward movement. But you could see what eventually happened. The market came all the way down. So basically this is what we have for this video. We'll be talking on other stuffs on the next episode, how to trade the smart money concept with all these terms. So when I start talking about when I start treating on how to trade the smart money concept, when you start hearing all these terms so that you won't get confused. So you have to go back, learn how to find them and what they actually mean, so that when you start watching the next episode you won't actually get confused. So that will be all for today's video. Thank you.